Convertibles, warrants, and derivatives. Overview. Convertibles. What are the risks of using convertibles? What are some advantages? Warrants. What are the risks of using warrants? Different kind of warrants. Derivatives. What are the risks of using derivatives and what is there to gain in using them? Convertibles are securities, usually bonds or preferred shares that can be converted into common stock, are ideal for investors demanding greater potential for appreciation than bonds provide and higher income than common stock offers. Investors like convertibles because they offer protection against heavy losses. Convertible calculation. A convertible bond has a par value of 1,000 and a selling price of 800 shares of this company are selling for $40. 800 divided by 30 is the conversion rate. The answer is 2667, which means it's less than $40, so the investor can decide to convert or take profit at this point. What are some risks? The financing with convertible securities warrant the risk of diluting not only the earnings per share of the company, common stock, but also the control of the company. The large part of the issues is purchased by one buyer, typically one investment banker and insurance company. A conversion may shift the voting control of the company away from its original owners. What are some advantages? Regardless of how profitable the company is, convertible bondholders receive only a fixed limit income until conversion. This is the advantage for the company because more of the operating income is available for common stockholders. Bond interest is a deductible expense for the issuing company. The federal government, in effect, pays 30% of the interest rate on debit. This way, bonds have advantages over common and preferred stock to a corporation planning to raise new capital. Warrants, securities that give the holder the right but not the obligation to buy a certain number of securities at a certain price before a certain time. Why are they important? Companies use stock warrants to attract more capital. This is crucial to startups. When a startup issues bonds or shares of preferred stock, it can include warrants to make the stock or bonds more attractive to investors. Different kind of warrants. There are two different kind of warrants, a call warrant and a put warrant. A call warrant represents a specific number of shares that can be purchased from the issuer at a specific price or before a certain date. A put warrant represents a certain amount of equity that can be sold back to the issuer at a specific price. What are the risks? The higher the price of leverage and gearing of warrants is not good for investors as they have to take more losses than gains as the percent of losses of warrants increase, which is involved with the value of this certificate which will be provided is the certificate value can drop to zero due to which the warrant may lose the redemption value. What is there to gain when using warrants? Long-term horizon. This means investors can wait several years before buying underlying shares, improve capital management, opportunity to leverage an investment, alternative to standard options. This can improve investment diversity and allow investors to profit from more dynamic market circumstance. Derivatives is a contract between two or more parties whose value is based on an agreed upon underlying financial asset or set assets. Common underlying instruments include bonds, commodities, interest rates, and stocks. Important because it's used as a risk management tool by which you can transfer the risk associated with the underlying assets to the party who is willing to take the risk. What are the risks of derivatives? The most dangerous is that it's almost impossible to know any derivative real value. Based on the value of one or more underlying asset, their complexity makes them difficult to price, and also time restriction. What are some advantages? Frequently used to determine the price of the underlying of the financial markets, they also help organizations get access to otherwise unavailable assets or markets. Those are my references, and I hope you guys learn more about convertibles, warrants, and derivatives. Thank you.